Recently, Evergrande's bankruptcy sent shockwaves through the markets. But what if another significant bank were to follow suit this September? There's increasing chatter that we might be approaching a critical juncture. As always, welcome back to Moneyside, your go-to spot for everything XRP related. If you're new here, don't forget to hit the subscribe button and ring the bell for up-to-the-minute updates on all our XRP discussions. Enjoying our content? Show some love by hitting that thumbs up and share your views down in the comments. Kim.com recently warned of sirens sounding non-stop across America. But what is he alluding to? Is it natural disasters, the turbulent markets, or the fragility of the current financial system? The phrase, "Saturn's main danger imminent," has been circulating, suggesting that America might be on the cusp of a significant event. The storm is upon us, as some say. Given these signals, this September promises to be a month to watch closely. However, according to BC Backer, we haven't hit the market's peak yet. This sentiment aligns with a narrative we've discussed previously. Notably, Senator Elizabeth Warren recently tweeted a proposal that's garnered significant attention, with over 22.2K likes. She argues that members of Congress and their spouses shouldn't be permitted to own or trade individual stocks and is pushing for a bipartisan bill to implement such a ban. This is a significant development, and it's remarkable how many people are resonating with this idea. It's undeniably clever, the strategies and proposals that are being put forward. The overwhelming consensus is that Congress should not trade with insider information. It's illegal, and more importantly, it gives them an unfair advantage against the general populace. It's almost paradoxical, the idea that Congress would advocate for their own trading restrictions. But what happens when these key players, like the Federal Reserve and Congress, are sidelined from the market? Once a bill that restricts them from trading individual stocks becomes law, many speculate that this will signal the market's peak. We should interpret such movements as warning signs. The current sentiment is that we haven't reached the top yet, but when the trading ban for Congress is implemented, there's a widespread belief that it will spell doom for equities. Following this potential market downturn, many expect the dollar to rally. Adding to the intrigue is the increasing chatter around the BRICS narrative. As history has shown, many get caught off guard by these shifts. There's a misconception that the dollar is on the brink of collapse, but in contrast, some experts believe it will rebound dramatically. An illuminating example of the insider dynamics at play was a recent exchange involving Jerome Powell, the Federal Reserve's chair. When questioned about attending a lavish party hosted by Jeff Bezos in January 2020, just weeks before a major stock market downturn, Powell evasively commented, "I don't talk to anybody." Events like this raise eyebrows and reinforce beliefs about insider trading. Such incidents cause many to wonder, do elites have access to privileged information that facilitates their immense wealth generation? In January 2020, at the height of emergency repo operations, Jerome Powell attended a lavish party thrown by Jeff Bezos. This took place right before the repo was pulled back, leading to a significant market crash. Many believe that key figures were well aware of impending events, suggesting that this could have been premeditated. Enter Senator Elizabeth Warren. Publicly, she seems to champion the rights and interests of the average American, advocating for measures to restrict congressional insider trading. However, there's skepticism regarding her true motives. Some suggest that while she may appear to be defending the public, she's actually aiming to protect the elites, ensuring they're safeguarded when the market collapses. The speculation is that these elites might find refuge in assets like dollars, gold, silver, and perhaps even cryptocurrencies. The magnitude of the United States financial situation is underscored by considering the sheer enormity of a trillion. To put this in perspective, 1 trillion seconds is equivalent to over 31,000 years. Spending $1 million every day since the crucifixion of Jesus Christ wouldn't even total $1 trillion. This staggering scale becomes even more alarming when we look at the current U.S. debt levels. Household debt, $17 trillion. Mortgage debt, $12 trillion. Auto loans, $1.6 trillion. Credit card debt, $1 trillion. This colossal debt signifies a looming problem. The American economy is precariously balanced on a mountain of loans, from student to auto. As people struggle to meet basic needs, they borrow even more, perpetuating a vicious cycle. It's clear that the nation's economic foundation is shaky. Many are waiting for the proverbial domino to fall, initiating a chain reaction of economic consequences. The prevailing sentiment is that something has to give. And before it does, it seems that Congress might preemptively ban themselves from individual stock trading. The narrative suggests that Senator Warren will be praised for this move. But is it genuine concern for the public, or is there an ulterior ulterior motive. The U.S. government's soaring debt raises pertinent questions about Congress's past actions. Why didn't Congress enact trading restrictions on themselves a decade ago? Many believe it's because insiders knew market trends and wanted to capitalize on them, leading to wealth accumulation through insider trading. This perception fosters skepticism regarding the fairness of the current financial system. The debt of the U.S. government is expected to rise by an alarming $5.2 billion daily for the next 10 years. Despite these clear indications of financial stress, some still dismissed concerns about potential credit events. However, recent actions by credit rating agencies like the S&P 500 Global and Moody's underscore these worries. They have downgraded several U.S. banks, specifically those with significant commercial real estate exposure. This move has caused shares of several of these banks to plummet. Additionally, the real estate market is showing signs of strain. ACS's recent data indicates that existing home sales have dwindled to rates last seen in 2010. High mortgage rates, reaching up to 7-8%, have made it increasingly difficult for people to afford new homes. This is a clear indication of the need for a market reset or collapse. A potential market collapse could have a domino effect, endangering various sectors, including the housing market. If this occurs, those with liquid assets might have opportunities to diversify their portfolios, purchasing real estate at reduced prices, among other investments. As we dive in, it's clear that the S&P's recent decisions are shaking up the banking sector, which is still reeling from earlier upheavals this year. We witnessed the collapse of 3 regional banks, leading to widespread industry disruptions. As the Federal Reserve grapples with inflation by extending higher interest rates, the foundational aspects of bank balance sheets remain vulnerable. Monday's headlines were all about S&P reducing ratings for Associated Bank, Valley National Bank, and others due to heightened funding risks and increasing broker deposit dependencies. UMB Financial Corp wasn't spared either. As expected, this cascaded to impact stock prices. The takeaway? There might be stormy skies ahead. To put it into perspective, S&P made significant cuts. For instance, America's rating shifted, I believe, from AA+ to AAA. These shifts can't be dismissed as mere fluctuations. They're alarm bells. Now, here's a jaw-dropper for you. Charles Schwab has looming debts. They owe a whopping 130% of their total equity capital in short-term FHLB loans, with assets tallying up to $350 billion. The shadows of past financial collapses loom large. Remember Bear Stearns in March 2008 or Lehman Brothers in September 2008? This year saw Silicon Valley Bank crumbling in March. The looming question, could Charles Schwab be the next domino to fall this September? History might not exactly repeat, but it often echoes eerily. To thicken the plot, there's word about Swift gearing up for an upgrade in its message standard come November 2023. They're aiming for asset tokenization, with 2023 potentially being marked by another banking crisis. This move by Swift is intriguing. Let's zoom out for a second and talk about CBDCs. Ripple's data suggests that a staggering 90% of central banks are delving into CBDC exploration. The narratives are evolving fast, and we'll delve deeper into this in a subsequent video. Wrapping up today's deep dive, Charles Schwab's situation? Likely more than meets the eye. It's indeed an intriguing time in the financial world, isn't it? Here's a tidbit to ponder. Charles Schwab is reportedly gearing up for job cuts, downsizing some of its corporate branches and closing others, incurring costs between $400 to $500 million. Is this preemptive action ahead of a looming September storm? While I'm not giving financial advice, the series of events feels a little too coordinated. Let's stack it up. October sees student loan payments resuming, potential government budget shutdowns, and space lockdowns. Whispers are going around that we might see more such developments, possibly more bank failures. And isn't it curious that there's an emergency alert test scheduled for October 4th? There's a whirlwind of activity happening and on the horizon. And about student loans, a growing number of borrowers are expressing their refusal to pay. It's evident people have reached their limit. Many argue that we're on the brink of an economic reset, one that could eclipse past recessions and depressions in scale and severity. Remember the downturns of 1929, 2001, and 2008? What's brewing now may be even more significant. Some speculate we're headed towards an unprecedented economic event, so monumental that we might lack the words to define it. In wrapping up, while we can't predict the future with certainty, there are clear signs pointing towards a substantial shift in our financial landscape. In my humble opinion, the winds of change are not just blowing, they're gusting. It seems like those in the know are meticulously timing their moves, ensuring every decision is impeccably executed. Please remember, I'm not a licensed financial advisor. The content presented in these videos is purely for entertainment purposes. I always encourage viewers to conduct their own research and consult with professionals before making any financial decisions. Thanks so much for tuning in. If you enjoyed the video, please give it a thumbs up and don't forget to hit the subscribe button. Also, make sure you turn on the notifications to be the first to know when I release new content. I'm excited to catch up with you in the upcoming video. Take care.